first of all, I guess I'll introduce TaxScouts very briefly. Can we go to the next slide? Yeah, perfect. Essentially, TaxScouts is an online provider of tax return service where a qualified accountant files your tax return for you for a fixed fee of £119, including VAT. As a business, we strive to simplify tax, and that is evidenced through the service itself and the user journey. We will only ever ask you to answer a few simple questions. Where possible, we will also import your financials directly from the HMRC to simplify the process even further. We will then ask you to follow a few simple steps, after which you get assigned an accountant will start working on your tax return and sort of working with you to make sure it's correct and accurate, and then file it with the HMRC. This slide is just a very simple illustration on our service and the simplicity of it. But without further ado, I think I will introduce you to our lovely speaker, Andrew. Andrew is one of our accountants who's been with TaxScouts for a year now. I will let you do your own more thorough introduction, Andrew, if there's anything particular you want to share. And I think from this point on, over to you.
Thank you very much. And hello, everyone. Welcome to the presentation. My name is Andy. As Patricia said, I've been here for about a year with TaxScouts. I've been working in the personal tax sector for probably just shy of about 4 or 5 years now. Been an accountant for about 10, so property tax is something that I'm quite well versed in at the moment. It's quite a hot topic, and it has been for the last few years. You've got my website address there, which is currently under maintenance. I'm just currently getting a BSL version of the website. A big portion of my clients are sign language interpreters, and I've got quite a few deaf clients too, which is a bit niche. So I'm getting a access website for them. So if you have any questions for me, my email address is as@tchltd.com. And I'll be happy to answer any questions, as Patricia says, or of course go to TaxScouts if you have any questions. But without further ado, you are here to learn about tax, not about me. So let's get cracking with the slides. So in today's session, we are going to go through a number of things regarding property tax. Some things will be just glazed over because it's quite in depth. It can be property tax. For the most part, for most people, it's just you pay tax on your profits and that's it. But there are a lot of intricacies and different complexities that we can go into. Appreciate that a lot of these might be, again, a bit niche. So if you think that there's something on here that may apply to you that I don't cover, please feel free to give either me or TaxScouts an email at the end of the session. The slides are going to get sent to everyone, so you'll have all our contact details, and we'll be more than happy to hear from you, of course. So the session will go through some key dates and deadlines, which are very important to avoid penalties and interest and get your filing correct. What tax do you pay on property income, how to offset losses? That'll be another section we cover. How to invest more tax efficiently, communicate with HMRC, and we'll finish it all in a Q&A. So some of the basics to start us off. So these are some dates for your diary, as it says on the slide. So the tax year runs from the 6th of April to the 5th of April. We seem to be one of the last countries in the world that have such a confusing tax year, but it's been the same for a while, so it's not so bad. The tax return deadline is the 31st of January, so it's important to say that this is the deadline whereby your tax return has to be filed, as long as it's filed on online. Paper ones 31st of October, sorry. Your tax has to be paid by this date as well. Any tax due has to be paid by the 31st of January, otherwise you will start incurring interest. It says here you can file from as early as 6th of April, and a common misconception for people is that the earlier you file, the earlier you'll have to pay your tax. It's true that if you get it in nice and early, HMRC might say just to kind of G you up to get some money in their pocket. But rest assured, if you file your tax return on the 6th of April, you still don't have to pay it until the 31st of January, unless, of course, you have any payments on account due for the 31st of July. Just a quick brief rundown of payments on account, because I know that this is, again, another contentious issue that people don't quite understand. And it's not, when you do tax returns, it's not very well put to you by the HMRC. It's not readily available that your payments on account are, if you earn, if you have a tax liability of over £1,000, provided that other conditions are met. Sometimes you have payments on account, which means your tax bill, say for January, is £1,000. Therefore, they want you to pay 1,500. So they want you to pay 1.5 times in January, and then £500 in July. So in essence, by July, you should have paid your tax bill twice. But then the amounts you've paid on account will come off your next tax bill. So if your next year's tax bill was £1,000 again, we've already paid it. So you'd only be liable for the £500 in January and the £500 in July. So going forward, it can be, it'll be fine in your second year onwards. If your income's staying the same, it'll be absolutely fine. And obviously, if your income dips, you'll end up potentially getting a reduced payment on account or even a refund. But for the very first year, especially if you've got quite a high tax bill, to be told, you now have to pay 1.5 times can be a bit of a pain. So that's part of this. We'll be looking at sort of, what we can do to reduce the tax bill as well. Anything that you don't know you can claim for is always a big thing. Probably one of the biggest questions you get asked an accountant: what can I claim for? And it's probably the most important thing as well. So let's go on to the next one. So the tax you pay on your property income. So the stamp duty, that's more of a legal thing. If you're going to, if it's a rental property that you intend to sell in the future, obviously it's important to know how much stamp duty you've paid, because it can be a cost against the capital gain. But for the tax workshop, the main things to worry about is the rental income tax, which is literally your rental less your expenses, pretty much at your tax rate, whether you be 20, 40, 45% taxpayer. This is, again, like any income, it's only if you've earned over your personal allowance are you liable to tax. So potential national insurance, if you're a property business and you're a self-employed property business, it doesn't come up a lot, but it does come up sometimes. But you may be liable to some national insurance as well. And of course, when you sell your property, you may have to pay capital gains tax if your gain is in excess of £12,300. So let's get into those in a bit more detail. Start with stamp duty. Again, I'll gloss over this a little bit because the rules are changing at the moment. Again, with COVID, they've had that they've had the stamp duty holiday for, I think it was up to 500,000, and that's gone down a bit now, I believe. And for normal times outside of COVID, the illustration here shows you what the stamp duty is. The most important thing on the right hand side of the slide is the additional 3% stamp duty. So if you already own a house, even if you own it through a company or you're a part owner, when you have another invested interest in a second house, you are liable to this 3% stamp duty, which is on the whole value of the house. So again, it can be quite an expense when thinking about investing in a buy to let arrangement. Says here, obviously Scotland and Wales have different rates and exemptions, but for the most part, this is what we are discussing. So we'll leave that where that is, and we'll get on to income tax. So this isn't just for property. This is for any kind of income that you earn. For up to £12,570, you won't pay any tax on that. Then between 12.5 and just over 50, your basic rate, and then above that, the 40% and the 45% additional rate. So every year, the rates change ever so slightly. It's worth keeping an eye on the rates because it can affect things such as child benefit and other state benefits like that. So it's always worth keeping up to date, especially when you go over the 100,000 mark, if any of you are in that sort of earnings, because you start losing your personal allowance. When you go over £100,000, that 12,570 starts reducing by £1 for every £2 you earn over the 100,000. So it's definitely worth looking at ways, if you're at that level, to maybe think about starting investing in a private pension if you have sufficient allowances for that, to keep that down. But that's not to do with rental property really. So let's get cracking to the next slide. So rental income tax from jointly owned properties. This is probably one of the most important, or at least up there with the most important ways to look at tax planning. If you've got a jointly owned property, especially if you're married or in a civil partnership, you're expected to keep the records, obviously, and file on separate tax returns. It's definitely worth noting that I think I've had some people that earn, they have property income and they both earn below the amount, so they think I will just lump it onto one tax return. But if you've got half a registered interest in a property, definitely get that on your tax return to pay your tax on your share, if any tax is due, of course. If you're not married, for the most part, your share of the profits is 50-50. That would be the most, 99% of the time that's the case. Again, if your situation slightly varies, you'll be such a sort of a statistical anomaly that it'd be worth coming and bringing me your exact situation, because, it's not very common that that's the case. But if you are married or in a civil partnership, the rental income will be assumed to be split 50-50, unless you want it split in a different way. And although it does sound a bit like a tax avoidance thing, it's really not. There's a form called a Form 17, and I believe that has to be filed with a deed of, or a declaration of trust, which can basically say in certain circumstances we want to split the property differently. So you could say, if you had one taxpayer, one of the married couple or civil partnership was on 100,000 plus, and the other one was a stay-at-home partner, then you're sort of, you're better off getting into the majority of the rental income, on the lower earnings partner. Sorry, excuse me, I really tripped over my words there, because I've just realised that we forgot to do a poll. So, Patricia, shall we do the poll now before we continue?
Sorry,
okay?
I didn't mean to make you trip over your.
No, I completely forgot. I've got a note here and I completely forgot, so I'm sorry.
Yeah, no, we wanted to do a quick poll, actually, just to understand your circumstances in terms of, in which landlord category, for one of the better words, you fall in. So I'm just going to launch it now. I hope everyone can see it. Essentially, what we're trying to understand is which of the below best describes your situation. So are you a landlord with one property that you let out? If you have whether you have a property portfolio, are you an Airbnb host, or do you rent a room in your own home, or do you let through a limited company? Just because the reason we wanted to do the poll was to give us a better idea of which presentation parts we might want to focus on a little bit more. So if I give you a few more seconds to finish it off, and then I will share the results with you as well. Cool. I think we're pretty much done. 5 more seconds. 5, 4, 3, 2, 1. There we go. There we go. So it seems that we have 62% of all attendees have one property that let out on the site. And then the next sort of biggest chunk, I guess, is some landlords with a property portfolio. Thank you very much for your time, and sorry for the interruption. And sorry, Andrew, I didn't mean you to trip you over.
No, I should be good at dealing with that. That's fine, don't worry. So excellent, thanks, Patricia. So for everyone else, let's continue. It's interesting that there's a lot of people here with just the one on the side. That's probably the most common type of rental. People who have maybe inherited a property along the way, or got married and decided to keep one of their houses if both partners own a house, or things like that. So yeah, not unsurprising, I suppose, but excellent, because hopefully there'll be a lot in this webinar that will speak directly to you. So just to quickly reiterate over the last point I managed to distract myself on, basically, yeah, so if one of you earns quite a high amount and the other one doesn't, especially if you're in the higher rate band, you can then utilize the other person's basic rate band, or even if they don't earn anything, you can utilize their personal allowance, and you can distribute the profits. But to do so, as I said, you have to submit this Form 17 and a declaration of trust. And as far as I'm aware, it cannot be retrospective. It will the split of the property will be from the day that HMRC received the form, or indeed accept it. So worth noting that if you think, oh, I've just done a full year's rent, my husband or wife doesn't earn any money, so I'll put it in her name or his name. That you can't do that. You have to make sure that HMRC know about it ahead of time. So we briefly went on national insurance. Again, I will glaze over this one because it's not very common that people have an entire business as just properties. Usually it's more seen as an investment thing rather than a trade. So, but if you do have a property business, same as any self-employment, profits over, I believe, just over £9,500 will be liable to Class 4 NI. And you've got the Class 2 NI, which is important if your only source of income is the rental properties, because the Class 2 NI is the national insurance that will give you a full state pension on modern rules, and make sure you're still claiming your credits for that. And that's for just over £6,500. So that's national insurance. The other important one, which I imagine a lot of people will be looking at the moment, especially with the way the mortgage interest has changed over the last few years, and people are paying a lot more tax on their properties, so it's the capital gains. So properties, like any other capital gain, over a £12,500 gain, and you're liable to capital gains tax. A lot of capital gains in the UK is done at 10 and 20%. But residential property is done at 18 and it's 28%. It says 20 here. That's my fault. I should have checked that properly. But it's 18 and 28% for the higher rate taxpayer. So if you're looking at, there's obviously a lot of different reliefs you can get if you're looking at selling a property. If you've ever lived in there. There used to be a thing, or there still is a thing called lettings relief, but that's a lot harder to claim these days. But if you basically lived in the property whilst you were renting it out, and you could potentially claim a lettings relief. Again, the main relief will be the primary principal residence relief, which when you've lived there, you'll work out your capital gain. You divide the whole ownership of the property by the amount of months you've owned it, and then you times the gain by the amount of months you're in there, and that will be a relief against capital gains. Again, happy for people to come at me after this if they want, and sort of give me their situation, if they're looking for any tips on how to try to save money if they're selling a property.
We actually had one question that it's probably very relevant for this point, from Neil, who said, I'm in the process of selling my rental property. My understanding is that capital gains tax payment must be submitted 30 days after completion. And do we offer the capital gains service? So we do offer a capital gains service, so it's part of your tax return. But I don't know whether you want to elaborate on the 30 days, Andrew.
Okay, absolutely, yeah. So the 30 days is the new tax capital gains reporting. You've got the real-time capital gains tax. So if you sell a house, from the date of completion, you have 30 days to pay the capital gains you owe. It's worth noting that it's not every time you sell a house. If you sell your main residence, obviously you don't have to do it. If you sell an investment property, if you don't have any tax to pay, or it's below a certain threshold, you may not have to report it. It's definitely worth looking at the gov.uk website and looking for real-time capital gains, because there are a lot of different rules. I believe TaxScouts offer obviously the tax return service, but the 30-day thing might not be included in that, because obviously if you've sold a property, Sorry, was that?
No, we don't. So the real-time capital gains is not something we offer. So I should make that clear.
So yes, obviously, if you've made the gain today and you've got 30 days, it will have to be included on your next year's tax return if you do a tax return. But what the 30 days thing is, I imagine it's for HMRC to get a bit of money a bit quicker, and it's to stop people having to do a tax return if they don't need to do one. And you can just report it. So yeah, obviously TaxScouts, they at the moment don't have a service for the real-time capital gains. Obviously, me personally, I do. So you'll have my contact details after. So it'd be lovely to speak to you, and I'm sure I can offer a bit of a discount as well for anyone in the webinar. I won't do codes or anything like that. I'll trust you if you say it into the webinar. I'll trust you. So that's the 30 days. It's one of those things where when it first came in, people were very much it's a pain and it's this, that and the other, but it's probably actually overall quite fair as long as you get the right advice, because it's not something you want to dwell on until the date that you actually come to do a tax return, because by then you might forget certain expenses and you might forget, mislay your legal fees and things like that. So it's quite good just to get it done, strike while the iron's hot, as it were. So moving on, furnished holiday lets. So this is another subject that is definitely worth talking about. There's a lot of different tax elements to the furnished holiday lets, and if you do run a furnished holiday let, I assume that part of the reason you do it would be for these certain tax breaks. So for instance, you are allowed to claim all of the mortgage interest as an expense. We'll get onto the mortgage interest later on, but that's not necessarily, that's potentially a massive tax saving there. You can qualify for 10% capital gains provided you meet some criteria from HMRC, which is business asset disposal relief. Instead of council tax, you're liable to pay business rate property tax, and in some instances you can get the relief. So you might basically find you're paying slightly less out if you have a furnished holiday let, but there are some conditions. So the property must be furnished. It's called a furnished holiday let, so that's hardly surprising. It must be within the UK or the European Economic Area, and you must be let commercially and with the view to make a profit. So if you have a sort of holiday home that you and your family and friends visit, obviously that's not a furnished holiday let. The days here, excuse me, the days here are quite important. It has to be available to let for at least 210 days of the year and actually be let for 105 of those days. Any family and friends who stay in the property for free or for a discount doesn't count in the above numbers. The rules surrounding it can be quite confusing, and it's definitely worth, if you're thinking of renting out a furnished holiday let, it's worth having a read of this link that we've attached here, because you don't want to particularly fall foul of it, just because when it comes to selling the property at a later date, it could really have a big tax implication on it potentially. So definitely worth doing your research on it if you're thinking of doing one, or if you have a furnished holiday let that you're not sure applies. It's definitely worth doing your research before you start putting it on your tax return as an FHL. So let's get into some tax efficiencies, which I'm sure is probably what most of you wanted to get to if you're renting out property, because this is how we try to make sure that, not that you're not paying any tax, but we like to make sure that you're paying not a penny more than you should do, because that's what we're here for. So let's look at the tax allowances and reliefs. This is just going to be a basic rundown of things before we get to the actual expenses you can claim for. So obviously you have your personal allowance, which is 12,570. Any income you earn lower than that, pretty much no tax. It says here your personal allowance may be bigger if you claim marriage allowance or blind person's allowance. Again, they're allowances that, if you claim them, you probably know what they're about. So I won't go into too much detail. And as I mentioned before, as soon as your income goes over 100,000, you start losing that allowance. So the starting rate for savings, this is one that not a lot of people know about, but basically if the majority of your income is from bank interest, say, and you're earning below £12,500 from other sources, you get a £5,000 starting rate for savings. So basically it does what it says on the tin. You can earn £5,000 of savings interest without paying tax. For every pound over 12,570 that you earn, you start losing a pound of that. So as an example, if you earned exactly £12,570 from your PAYE job and you had £2,500 of savings interest, you have £2,500 left in your the £2,500 obviously covered by the rate. If you had £12,500 of PAYE income, £4,000 of property income, then you get £1,000 of your starting rate, and then but you also do get a personal savings allowance on top of that. This is for people who, we're getting to the realms of people who are earning £1,000 in savings interest, which I don't think is particularly common these days with the interest rates being what they are. But then I suppose our mortgage interest payments are a lot lower as well, so it's kind of good and bad. So the personal savings allowance, it's a way to I think it was brought about to stop people having to do tax returns. So if you earned £100,000 a year and you had £200 in taxable income, taxable savings interest, you potentially could have had to have done a tax return to pay the extra tax, because you're probably getting it deducted at 20% at source, if anyone remembers when you used to get tax deducted from your savings interest. So I suppose it's a way just to have taken a lot of people out of self-assessment, and it has done the trick as well, because you don't really want to have to file a tax return when you earn £25,000 a year and you get 500 quid savings interest. It's a lot of admin for not a lot of gain, really. So yeah, it's a great introduction, I think, to the tax system. Another good one here is the property income allowance. So this, now we're getting relevant to you guys here. So if you've got a property that you rent out and you don't have many expenses, if you manage it yourself, you don't have a mortgage, you can, if you have hardly any expenses at all, maybe a gas safety check here and there and a little bit of materials, you can claim £1,000 in property income allowance. It's the same with if you're self-employed and you don't have any expenses, you can claim £1,000. And in the property, it's great because if you're joint, you can both claim £1,000. So if you had a rental that's giving you £10,000 a year, £5,000 each, and you've got no expenses, well, you've got £4,000 profit each. So it's quite a good allowance to have. Or if your expenses are teetering on the edge of £1,000, but you can't prove the expenses, you haven't got the bills and whatnot that you need to prove the expenses, should HMRC look into your affairs, then it's another good one to do, because it's just a cut and dry. I'm claiming the property income allowance, and it's absolutely fine. So you see the eligibility criteria here. This will be a good one to look at again when the slides get sent out to everyone. So you can see the criteria. As long as there's the few boxes ticked, there's not a lot of instances where you can't claim this allowance. So it's definitely a good one to think of. Any good accountant would have advised that anyway. So if you're renting an Airbnb, for instance, and you're just renting one of your rooms, or you've converted garage or something like that, you might think it's a good one, but it's actually not in your instance, because you will potentially have the rent-a-room scheme, which you can claim £7,500 instead. If you're renting out a buy-to-let or a second property, it might look like on the surface that your expenses are less than £1,000, because now you can't claim the mortgage interest the same way you did as before. But if your mortgage interest is still over £1,000, it's definitely worth doing that. Again, as with any of these, if you're not sure, a lot of these subjects you might look at and think, well, I'm not actually sure if that applies to me or not. Drop me a line, speak to TaxScouts. The TaxScouts support are really good at these questions. They do it all day, every day, and they're they're really good with this. So that's the property income allowance. The rent-a-room scheme. This is a great scheme for those who are Airbnb and a room out, especially when it's it's seasonal. You might get someone who lives near a venue or somewhere where there's a festival every year, so they might make a lot of money in this brief period. If it's less than £7,500, great, no tax to pay if you're eligible. A point on the eligibility: if you're a resident landlord, it doesn't mean that you own the place. It's basically in essence a sublet, but you'll have to make sure that you're allowed to sublet the premises, I suppose. That's more a legal point of view. I can't give any advice on whether you're allowed to sublet your premises, but I can give you advice on whether you have to pay tax on that sublet. Running a guest house or a bed and breakfast, again, you can technically claim the rent-a-room scheme. A lot of my clients who have B&Bs, their expenses are more than £7,500, so it's worth them actually claiming the actual expenses as they arise, rather than the rent-a-room. And it says here, if you're jointly owned, again, you split it 50-50, so 3 to 750 each. So that for the most parts, for a rent-a-room, that should go to some way to covering the amount of rent you receive. So mortgage interest tax relief. So this is the big change over the last few years in renting a property, as I'm sure, as many of you are just renting one on the side, I'm sure you'll know about this. So up until 16, 17, you used to just claim all the mortgage interest as an expense. Done. They've slowly started dwindling that away. So it was 75% with 25% as a tax credit, then 50-50, then 75-20 the other way, and now it's nothing. So if you have £2,000 of mortgage interest, that doesn't go against the profit of your rental property. You do still get tax relief on it. It's on a different way. And if you're a basic rate taxpayer, you shouldn't notice any difference in your actual tax bill payable. However, if you're a 40% taxpayer, because it's not the profit being reduced, you're going to pay 40% profit on your tax, and then you're going to have 20% deducted later on. So you're now 20% of that amount worse off, which goes back to the potential to split the invested property percentages with a partner if you qualify, to make sure you're using up their basic rate band, because it's a tax reducer as well. So if you don't earn over a certain amount, you can't the credit at the end of your tax calculation, it can never cause a refund. It will only ever restrict it to no tax. So if that's the case, it carries forward. So it's a wildly convoluted system that, if you're in that area where you have to carry it forward, you have to remember on your tax returns to work out how much financial relief you've got, and if you've not used it all, you have to remember to carry it forward to the following years if you need it, etc. So in that instance, it may be worth getting hold of an accountant, because obviously we keep all that detail. It's a bit of a pain. We've probably gained quite a lot of clients through the complexities that HMRC seem to have added on this. So it is a bit of a pain, but it's the system, so I'm sure it's fine. I'm sure there's a reason. So as I was saying, you get 20% of the tax credit to use against the lowest of your property profits, mortgage interest, blah, blah. So if you're a basic rate taxpayer, as I said, there's no change. If you're a higher rate taxpayer, you will end up paying a bit more tax on your property. And that's why so many people are selling their properties, and it's just gone in line with this new 30-day capital gains tax. So, I think the government are definitely getting a lot of money quicker, which is, it's great really, because they can definitely do with getting a bit of money in at the moment. So rush through it a little bit. I'm hopefully that I've covered most of the points that will be prevalent, at least in a little way, sort of just to give you a taste of what questions you can ask, and that leads us to the questions, the section. So what I'm going to do, if it's okay with Patricia, is I'm going to look at the Q&A section, and I'm going to answer questions, if that's okay.
Yep, that's perfect. And we had a few questions in the chat as well, but I'll pick them once we've done with the Q&A section.
Brilliant. So we've got a couple of questions here. Can I claim as expenses my car trips to the buy-to-let flat? Not sure how to calculate the mileage. What can be used as evidence? Okay, so a lot of with tax, whether it's for properties, self-employment, anything like that, usually the answer is it 100% for that purpose? If the answer is yes, then you should be able to claim it. So if you're traveling 200 miles to a property that you rent, and you're going there to go check the property, maybe do some repairs or something, then I would say absolutely put the mileage through for that. Lunch and dinner, that's more of a niche question. I imagine that for properties, again, it'd be the same as self-employment. So if you're working a certain amount of hours in self-employment, you may be able to claim for dinners. Very, very rarely can you claim for lunches, because wherever you work, whatever you do, you're expected that you're going to have lunch, aren't you? You know, it's part of most people's average working day that they're going to have a lunch break. So to claim for that, if you're working particularly early, or if you're working away from home, or if you're working late, or a certain amount of hours in a day, you may be able to claim some subsistence. So that would be another one that's definitely worth looking into from a personal point of view, at the situation, and looking at HMRC's subsistence guidance. And then I bought a couple of tools to be used for the buy-to-let flat. Can I claim that as expenses? So again, if you've bought, say, a lawnmower that you want for the buy-to-let, if you're taking it with you and mowing a lawn, then bringing it home with you, there's absolutely nothing to say that you're not using it at home. If you've got some tools that are specific for the buy-to-let and you're leaving them there, then I would argue that yes, you could claim for those, because they are only to be used at your investment property. And that is from Rachel, so thank you for that. Mark, where's that gone? There it is. COVID restrictions have impacted my holiday let turnover. Is there any compensatory relaxation of the minimum number of days occupancy for this period? So I'm not 100% sure on the actual legislation. I know that with a furnished holiday let, if you were renting it out for a few years and you were meeting all the criteria, and then you had a year where it completely drops off, I don't think they're particularly worried about that, as long as it then picks up. With COVID, as far as me and my clients have been aware, with things like that, usually it's a note in the white pages just to say, look, I know that the days have dipped under, but it's COVID, you know, what can I do? It was the government guidance to tell you that you couldn't rent it out probably anyway, so I can't imagine that there'll be any sort of penalty, or that you'll get penalised if your holiday let's not meeting the dates at the moment. If it doesn't pick up in the future after all the restrictions, then I imagine you might have to reevaluate your position. But for now, I can't imagine it'll be a problem if it's dipped below the days. Anonymous, if you're married and only one of you own a buy-to-let, can you split the profit with your spouse? So if you're married and you own a buy-to-let, as far as I am aware, you have to both be on the deeds to be able to split the profits. The good thing about marriage is that there's no capital gains. It's a no gain, no loss thing. So if you were to transfer half the property over to your spouse, you won't have to pay capital gains on that. So you could do that. There may be a stamp duty issue to look at if it's over the allowances as per previous slides. But I believe, I'm more than happy to prove them wrong, but I believe you have to both be on the deeds for you to be able to split the profit with it. Alex Dixon, by doing a split of ownership, are capital gains taxed in the same way, depending on the split? Absolutely. So if you've split the property 99-1, say, or 70-30, if you sell that property with that in place, then your the profits will be taxed the same. Or taxed in that 70-30 or whatever. So it's simple as, if you want to if you want to make the most of both of your tax, your annual exemptions on your capital gains tax before you sell the property, definitely look at putting that split back into 50-50, and then yeah, it should be fine. Will I need to pay NIC, etc. if I move out of the country for a few years and continue receiving rental income in the UK? Okay, so this is more of a, this is less a rental income question, more a tax residency and domicile question. So it depends where you're moving to with the double taxation reliefs. If you're going to become a tax resident of a different country, you'll need to know what their tax laws are. Usually for things like that, you are taxed in the country of residence. Don't forget, obviously, if you're still renting a property here, if you're especially if you've got a UK passport, you will still be liable to your £12,500 personal allowance. So it might be a question you want to put to me after this. You know, let me know where you're going, and I can check some double taxation agreements for you. That's not a problem. Right, can I carry a loss I made in year one rental forward, i.e. setup costs? Absolutely, as long as it's a income tax loss, not a capital loss. So for instance, you say setup costs. So if you've bought a house that needs some doing up before you rent it out, that will be seen as, you know, as expenses you've had to make to rent it out, and that's capital. If you've got a tenant in there, or say if you get a property in April and you start making costs like mortgage interest and advertising because you're trying to get a tenant in there, that's fine. Those costs are great. But the actual physical, you know, I've had to redo the kitchen, I've had to lay this new carpet before I rent it out, that's a capital cost. So that would go against your capital gains. What is a reasonable self-management rate? It's 300 a year, okay, without receipts. So without receipts is always risky business. You know, if you've not got any proof of your costs, I would say if you're looking at a self-management rate, the things you want to look at obviously are visits to the property. If you've had to do any physical work to the property, you can't claim your time. Obviously, you can claim the materials for the repairs. You can claim the mileage if you've gone to B&Q or such like. If you know, I say a percentage of your phone bill, maybe. If you're a property business, you might say, you know, I have to do X amount of hours at home a month, so you can potentially claim some use of home. But if you can't get receipts for things such as mileage, obviously keep a log. So get a diary every time you go to the property, how many miles it is round trip, things like that would be really helpful. If HMRC look into your tax affairs in the future. And yeah, I think that answers that one. Right, can you elaborate expenses and what can be claimed for new bathrooms and new kitchens? Right, so this is a more sort of in-depth than it looks question. Expenses, anything that is directly a result of having to rent the property. So if you're paying a gardener, or if you're getting it professionally cleaned, or if you've had to get a plumber out, or boiler service, anything like that, any physical costs of keeping that property going in its state is an expense. New bathrooms and new kitchens, that is a definite that depends question. If you're taking out the bathroom and kitchen and putting in a brand spanking new, all singing, all dancing bathroom that's much better than the one before, that's a capital cost, because if your tenant is in there and the bathroom's a bit of a mess and you're putting a like for like replacement in, that can be claimed. Most expenses that are involved in a property can be claimed. It just depends whether it's an income tax claim or a capital gains tax claim. And again, you know, any good accountant will be able to tell you the difference. So just pose the question to them if you're thinking of doing any work, and I'm sure they'll get you the answer.
On that as well, we do have quite a bit of sort of content and information around expenses on our site as well. If you want to, you know, go to TaxScouts and browse around, feel free to do so as well.
Definitely, yeah. It's actually in if any of you have other other sources of income, not just rental property. There's quite a lot of good guides on the TaxScouts website. To be fair, when I'm in my own business, I use the TaxScouts website quite a lot for guides and reliefs and things like that. It's a good point of reference, to be fair. So another anonymous one. So 2021 tax year, do you record on the self-assessment form 20% mortgage interest relief calculated amount, or do HMRC calculate after submission? Okay, so what you need to do is there'll be a section for restricted finance costs. So you need to put the whole amount of mortgage interest in there. So if it's £2,000 or whatnot, it will then immediately disallow that as a cost, and then lower down your tax calculation, it will bring 20% of that back in. So what you need to do, is you need to put the amount of mortgage interest in your tax return as restricted finance costs, and there'll be a section for that there. And another anonymous one, I'm building an extension on my investment property. Can I claim against any of the work? That's a capital thing. So HMRC will argue that's going to raise the cost of the property. So what I advise you to do is any costs related to this extension, keep it all in a folder, put it on a spreadsheet, anything you can to evidence every cost, the builders, the materials, everything. And then when you come to sell that property on the capital gains, one of the things you use against capital gains is any improvements to the property. So you'll need to have that whole amount, the more that you keep, the better, and that will go against your capital gains when you sell it in the future. Right, Arthur, do I need to pay capital gains with 30-day sale of a USA buy-to-let property? That is a great question. I don't think so. I think the 30 days is just for UK residential properties. I would be more than happy if you drop that on an email to me just to double check. You'll definitely have to pay capital gains in the USA, but I'm pretty sure that the 30 days is just for UK disposals. Own my investment property outright, but I'm taking out a buy-to-let to build an extension. Can I claim any of the mortgage costs? So you're basically going to have, you're going to raise funds to improve the building. This is probably another one that if you're happy to drop it on an email and let me know, just so I can double check the rules around what you can borrow for, and if you have the interest. I think this is probably a yes, but yeah, drop this one on an email to me if you don't mind, and I'll double check and get back to you. Neil, Andy, please can you share your website or contact details for the end of the session? Very useful webinar. Thank you. That's very kind of you to say. I'll just quickly drop my email address in the chat box. That's for anyone that I've asked to email me as well. Feel free to drop me an email on that, and I'll get back to you guys. And Neil, it'd be nice to get in contact with you as well about your capital gains disposal. Set up costs with furnishings mainly with discount. So if it's a furnished property, then no, basically, because it's part of the condition in which you rent it. So if the property is there ready to go, that's fine. If you have to replace any of those furnishings, then yes, you can claim that. But the furnishing of it, I believe, would be a capital thing. So keep that for your capital gains tax. Where does having a garden landscapes fit in capital versus expense? Garden was unsuitable for family renting and potentially dangerous. Once had their first child, she had to replace a patio, grass and fencing. Okay, so this is a good question. So I would say that what you need to look at there is what was the garden like before it became unsuitable. So if you landscaped it back to its original glory, then claim that as an expense. If it was unsuitable when you purchased the property, and then you've now completely redone it to do it up to into a much better condition, then I would say that was capital. Dennis, I inherited a single flat property from a deceased relative in another city a few years ago, which is managed through another firm who I pay, and which have a tenant who pays monthly rent. I've never lived in this property. Will there be further costs when it comes to finally selling the property after the tenant has left? Okay, so when you sell the property, you you obviously will have to pay capital gains on that. And as you've never lived there, you won't get any private residence relief. However, your base cost for the capital gains will be the value of it when you inherited it. So when your deceased relative, when they passed, their probate, they would have, this property would have been given to you and they would have had a value. So when you sell, it won't be on the value that they paid for it, it'll be on the value of it when it came to you. So if it came to you within the last couple of years, you know, the profit probably wouldn't be massive on it. So you might be just under the allowances, but again, there'll be no allowances for you as you've not lived there.
Marion has actually asked this question a while ago on the chat in a bit more detail, so I'll read it out. I have been asked to purchase a license by the local authority for my property I'm renting out. Is this claimable on my tax return? It's £600.
Okay, so if the license, if you can't rent the house without this license, then absolutely put that down into the legal and professional costs. It'd be interesting to see what the license was actually for, but if it, you know, yeah, if they say you can't rent this without the license, then yeah, you know, it's a cost that absolutely needs to be paid. So yeah, legal and professional, I would say that. And then the last question on the chat box: is there a personal allowance for a non-UK tax resident? That depends on where you live. If you've got a UK passport, for instance, then you still get an allowance. If you live in a country where we have a double taxation agreement that gives you a personal allowance, then you also can have one. Again, got my email there. So if you want to ask, you know, if you want to email me, let me know where you live. I'm more than happy to put a look into the double taxation agreement and see if you get a personal allowance. If not, it might be worth saying, if not, you can speak to the management company if they do it, and they can start deducting the tax at source. Again, so if you've not got a personal allowance here and you're going to have to start paying tax here, you can get the tax deducted at source, which means you shouldn't have to do a tax return.
I'm wondering, sorry, there's a few questions in the chat. I wonder whether we can go through a couple of those just so I can scroll down there as well, because obviously these just popped up and I think some of the people in the chat room have been waiting for a while.
Okay, yeah, go for it. Go for it.
So someone asked that COVID restrictions have impacted my holiday let turnover. Is there any compensatory relaxation of the minimum number of days occupancy for this period?
Okay, so I think that guy also put one in the Q&A, unless it's just a very similar question. The answer basically was, as long as it's a COVID reason, I have no doubt that HMRC will be very sympathetic, seeing as they themselves are the ones that have told you basically that you can't rent it out. So as long as it, after COVID and everything, it doesn't ongoingly not meet the conditions, I think you'll be absolutely fine.
Another one: why is my state pension in a different page to my private pension? It's an interesting question.
On the tax return, yeah, I imagine it's just because that, you know, all the state payments, so your state pension or statutory sick pay, things like that, job seekers allowance, etc., all on one page. And then your payment will be, your other pension will be another page. I wouldn't worry about it. They've all got their own separate pages and everything, so you know, don't worry about that.
Cool. And then I'll just one more from chat, and then we'll go back to Q&As again. Another one from Marion: are agent management fees deductible?
Yes, absolutely.
Let's move to the Q&A, and then I'll look for any other questions in the chat.
Okay, great. So first one: can you write off mortgage from capital gains? No, that's a income tax deduction for mortgage. It's worth noting as well, by mortgage, they also mean if you have to rearrange your mortgage and you get, you know, a couple £100 of fees to rearrange, put that in with your mortgage costs as well. It's also restricted, but it's also worth putting in there. I own my property outright. I'm getting married soon. Congratulations. Can I transfer some of my allowance to my husband? Absolutely. Firstly, you'll have to transfer some of the property to your husband as well. So you have to get them on the deeds. Again, if it's after you're married, it's a no gain, no loss thing, but be careful of the stamp duty. Worth seeking legal advice on that. But yeah, congratulations. I hope wedding goes well. We run a beauty salon and our business bank account also receives rental income. On my self-assessment, do I separate all our different types of income and expenses? So depends, is the rental income from a separate house to the salon, or is it, you know, does someone rent a room in that salon that you sublet or anything? If it's just a rental property, separate portfolio. Cool, thank you. That was very quick. Then yes, so you've got your self-employment income is your beauty salon, and then you've got your rental income. So it does need to be separate on the tax return. And yes, you can add TaxScout costs to the tax return. So any costs like that, any TaxScouts or you know, financial management for mortgages, etc., you can add those on your tax return. Sorry, I should say it depends if you're renting a property. If it's just P60, then no. But if for this it's rental property, then absolutely you can put that on there.
Perfect.